Welcome to this Openroom University class. Today we're exploring a topic that's both powerful and often misunderstood in Ontario's rental landscape. It's called the Above the Guideline Increases, or short form AGIs. If you're a landlord considering major improvements or facing a spike in property taxes, this is a session you won't want to miss.
I'm Weiting, co-founder of Openroom.ca. At Openroom, we collect and organize tenancy court orders across Canada to make rental outcomes transparent and searchable. We also report rent payment behavior to the credit bureaus such as Equifax, helping responsible renters build their credit while ensuring accountability across the rental ecosystem. We believe landlords are service providers who should be offering safe, legal, and compliant homes, while the tenants are responsible customers who should understand and meet their obligations in a lease agreement. Our vision is to create a transparent and connected rental ecosystem. And Openroom University exists to make sure that both sides have the knowledge they need to succeed.
Our instructor for this class is Allistair Trent, a licensed paralegal and a real estate agent who brings a wealth of practical knowledge and legal knowledge. Allistair is known for translating complex and legal procedures into clear, actionable guidance for housing providers. He's also been involved in high-profile landlord cases. In this class, we're unpacking the full scope of AGIs in Ontario, what they are, when they apply, and how they can help you manage your rental business responsibly and legally. You'll learn which capital expenditures and tax increases qualify for AGIs and, frankly, which do not, how to calculate and apply for AGIs under the Residential Tenancies Act, the limits, timelines, and administrative steps involved in the process, why AGIs are often best suited for large multi-unit buildings, what to expect when educating tenants, managing legal risk, and planning for retroactive rent adjustments, how AGIs can impact long-term cash flow, property value, and tenant relationships. If you've ever wondered whether an AGI could work for your rental business or how to do it right, this class gives you the clarity and confidence to move forward with starting steps. Let's dive in after a message from our sponsor. As a landlord, making your properties stand out to renters is more important than ever. That's why Rentals.ca offers verified listings, a free service that confirms your identity through Persona, a trusted third-party verification provider. Verified landlords get a badge on their listings, instant posting, and up to 3 times more leads than non-verified listings. With thousands of renters searching daily, getting verified makes your property stand out as a trusted listing that gives renters peace of mind. Get verified and list for free today on Rentals.ca.
Okay, great. And just a standard disclaimer, this presentation is just for information, discussion purposes, not intended to be a substitute for legal advice. If you'd like legal advice relating to an individual situation or any one of these topics, then you should contact somebody who's qualified and most especially with experience in this area. Speaking as someone who's done this from, as I say before, in the rent control times, it's not that these are necessarily that complicated, but they do involve fairly large amounts of money. And to be frank, I can count on my one hand the number of people that have been doing specifically this type of work for a very long time. It is very specialized. It's not that it's complicated or anything like that. It's just that it does have its own nuances. And usually, like as I say before, when we had the courts and the rent control tribunals, there were either people usually who did the court work and people who did the rent control work, because each one of them had its own particular nuances. And even now, most of the stuff relating to capital repair or AGI applications comes straight out of the old book for the rent control work. And similarly, a lot of the other type of things that you may be more familiar at the tribunal, like applications as opposed to abate the rent, like an abatement of rent, but applications to reduce the rent and this type of thing. These are all far more based on economic and accounting practices rather than they are the type of things that go on in the courts, like or in the tribunals, like abatements of rent. The majority of the things that come from the old rent control scheme are basically a numbers game, not, you know, things relating to equities or how it affected you or anything like that. So it's a different skill set, and it's a unique, it's different than dealing with the applications of the tribunal now has jurisdiction over, that come more from the courts, like abatements of rent and damages, and you know, the non-payment of rent and evictions and all of this. This stuff is heavily founded in accounting, as we'll see as we go through this. So the first thing I'll touch on is the capital expenditure Aggies, and they come under section 126, sub 2 of the legislation, where you can apply to the board for an order permitting the rent to be charged by more than the guideline for any or all of the rental units in the complex in the following cases. Eligible capital expenditures include incurred respecting the residential complex or one or more of the rental units. And the operative part to note about here is that it has to be a capital expenditure, which is something with a life expectancy of more than 5 years. The determination of whether it's a capital expenditure is much the same as it would be from a tax perspective, in terms of some things that you do to a building are expensed out of revenue, and some things have to be capitalized. And it's much the same type of a determination when you're doing determining whether things are capital expenditures. Like obviously a new roof, new elevators, this type of thing are capital expenditures. There are also things like that might appear to be maintenance, but which nevertheless fall under the ambit of capital expenditure, such as a common one is asphalt or driveway repairs, which, you know, can be done more regularly and may seem like a maintenance item, but those are actually can be passed through as capital expenditures. There is a list in the general regulation, regulation 516, I think it is, the last part of that regulation is a table of all various type of capital expenditures and their life expectancy. And if you're interested to see whether something's either a capital expenditure or analogous to or akin to one of the type of capital expenditures you can be claimed, then by all means look at the list at the end of the general regulation. Although I would say the list isn't exhaustive. There are, you know, it's fairly lengthy, but it doesn't really contemplate every possible thing you could possibly claim as a capital expenditure, but it gives you a good idea as to the type of things that are normally allowed as such.
Allistair, we have a question in the chat. Maria asked, what about a furnace and how do you find it?
Oh yeah, absolutely. A furnace is something that's commonly claimed, and you would go to the general regulation, which you can find on the board's website. It's the first regulation. It's just always been referred to as a general one. It's the one that basically covers everything, except, you know, as a distinct from the other ones that deal with very specific items. And it's right at the end of the general regulation. There's a table, and the table sets out, you know, useful life of work done or thing purchased, and it has a whole list of like pages and pages of items, like, you know, new boiler would be one of them, and they're all, thankfully, because there's so many of them, categorized, right? Like there's mechanical items, electrical work, site work, things that are like in the apartment. They're categorized by list. I can't remember another one as to what they're categorized as, but there's a heading for each one, and you find the most appropriate heading, and then you go down and look and see if what you're looking for is there. But definitely a new furnace is allowable, and I've done many of them, and is often claimed.
Yeah, Allistair, we can try to find the specific link for folks in a little bit. So let's keep going. Thanks.
Okay, so a couple of notes when you're talking about cap, you'll notice that the statute itself allows you to claim capital expenditures incurred, and incurred means that the project must be paid for in full before making the application. It's also pretty well obligatory because you're going to have to file the supporting material, which includes proof of payment of the actual work. Like when you do these, it's like I say, it's largely an accounting type function. So what you have to do is prove the items are eligible, which we'll get to, and then you have to prove that you spent this money on doing this work. So you'll usually put in, you know, either the contract or the invoice for or estimate for the completed job, and then behind that estimate, any estimates for progress draws on the job, if it's a larger job, and then the proof of payment for each of the progress draw invoices, this type of thing. But in any case, the point is that you can't apply before the project's fully paid for. The next point to note is that the project has to have been completed within 18 months prior to the application being filed, or technically it's actually prior to the 18 months before the day that's 90 days before the first effective date of the rent increase being claimed in the application. And because you have to set the first effective rent increase, like you obviously have to give the tenant 90 days notice. So you have to file the application in the month that you're going to be sending out the notices of rent increase for the first effective date. Then you go back 18 months beyond that, and the project has to be completed within that period of time. Now, when they say completed, it means it has to be finished. Like often you will have projects that take place over a great deal of time, like balcony reconstruction, for example, or underground garage concrete delamination and repair. And these things can take months, if not years. But as long as the project doesn't have to have gone on entirely within the 18-month period, it's as long as it's completed within that 18-month period. So if you had a balcony reconstruction that started 2 years ago, but got finished, you know, 16 months ago, then you could nevertheless claim it as long as the completion date was within the 18-month period. And the date of a given project being completed, you can use a number of things to establish that. Sometimes you get fairly creative when people are late sending you the applications and whatnot, but I've used any number of factors. The final payment is the easiest one. The release of the construction holdback, the 10% holdback that's retained pending the completion of larger construction jobs. Or I've even had one recently where we successfully used a municipal inspection, even though the municipal inspector took, you know, quite a while to get there, because it's like, well, the project can't be completed until we actually have a sign off from the city, because the city could have said at any time and did say, you know, no, these two windows are out of alignment and this type of thing. And so again, it'll depend on the project as to how you gauge its completion and the type of work that's being done, and also the fact circumstance. And also hopefully that you don't leave it until the 17th month before you give it to somebody to start working on. And that's usually a good way to get around that and avoid those type of projects as well. Now, if you are doing, another thing to do is that if you are doing a number of projects in a given building, like you buy a building for the purpose, I have clients who buy really old buildings that need a lot of work done to them with a view to doing all of this work and then getting the rent increases that result from them. And so you try and group your completion dates within 18 months windows. And so they'll do a bunch of work, apply, and then start the next 18 months, because you know, you can't have like all of this work going on at the same time. It's very sort of physically intensive work. So you do all your within an 18-month window, you'll do the roof, the balconies, whatever, and then the next apply, and then the next 18-month period, you'll do another set of work and apply, and so forth. But the critical thing to remember is to not let it overstay the 18 months, because it's not a period of time that the board can extend or has any discretion to do anything again about. It was actually interesting arguments during COVID, had these too, where there was an automatic suspension of limitation periods during the COVID pandemic. And so as a result, some clients had like just having to manage the whole thing from their office. And they took a little bit, a month or two after the 18 months to apply went down and what had expired. And interesting arguments, because I mean, even though it's a window back in time, the reality and the effect of it is in the nature of a limitation, because it basically says that after you do this work, you have 18 months to apply. So that was actually interesting too, but hopefully we won't have another pandemic and that won't come up again. And as soon as the work is done, start thinking about making application, unless you're going to do other major projects, in which case get them on the other ones done and look at an 18-month window. In preparing these applications, it's also not, there's a lot of clerical work that's involved in them, and it's not a situation where you give it to somebody and okay, within 3 days go and file it. It doesn't work like that. Like, you have to, for me anyway, it takes at least a week in the best of circumstances to get all the information. There's always some of it missing. You've got questions about this, questions about that. It's something that actually is fairly labor intensive to get it done, especially for a large building. If you're applying for a small building, a threeplex or whatever, then perhaps not. But as I'll get to it later on, it's not really practical to apply for these smaller buildings. It's something that generally is applicable to large multiple unit type buildings.
Allistair, let's just double click on that. So what you're saying is that for single homes, it's not ideal to do AGIs.
No, it's not. It's not only not ideal, it's a waste of your time and money in the vast majority of cases. And I'll turn to that when I turn to the maximum increase available in the financial numbers. Because it is literally where you're looking at apartment buildings, and as you know, if you're in the apartment building business, it's a business of measuring, counting nickels, right? Like you're like, if you get an increase in rent of 1% on a monthly rent roll of $100,000, that's great. If you get a rent increase of 1% on a rent roll that's a $2,500 apartment, that's not so good. Particularly if it takes you 3 years and a lot of aggravation to do it. So the next thing that has to be considered is whether the work that you're doing is an eligible expenditure. If it's an eligible expenditure, then it's inherently eligible, and you can use it for the purposes of passing on the cost to the tenant to the tenants in the manner I'm going to describe shortly. But an eligible expenditure falls into one of these categories. First of all, it would have to be necessary to protect or restore the physical integrity of the residential complex or a part of it. This thing would, like I was saying about balcony repairs, parking lot delamination and reconstruction, this type of thing. The next one is what you always put in when you're classing them anyway, is necessary to comply with subsection 21, which is the landlord's obligation to repair the property, or subsection 161 A to E, which I think is a concurrent thing for mobile home parks and this type of thing. But so if it's necessary to comply with the landlord's repair obligations, this would be stuff that's far more general, like I'm replacing the 20-year-old carpeting in the building or 10-year-old carpeting in the building. I think carpeting has a life expectancy of 10 years, just because it's necessary to meet my obligations as a landlord, and the old carpeting outlived its useful life, and that's the end of it. Away it goes. I'm putting in new. The next one is necessary to maintain the provision of a plumbing, heating, mechanical, electrical, ventilation, or air conditioning system. That's kind of fairly obvious, like someone asked about a furnace. So if it's a furnace, presumably it has to be changed or upgraded to keep the heating system functioning, inherently eligible. The next one is it provides access for persons with disabilities. And this can be even if, like, we've had cases where the tenants have gone to the Human Rights Commission and said that, you know, I want a wheelchair accessible entry door and all of this type of stuff. And okay, great. So you can have a wheelchair accessible entry door. And by the way, I'm increasing the rent for everybody in the building to pay for the wheelchair accessible entry door and whatnot. I mean, these things are inherently and automatically allowed to be passed on, and in many cases they're good things to have anyway, because you get a, like, particularly now there's a lot of older tenants and whatever, so some of them use scooters and all of this, and you know, some degree of a question, which you know, another case I've got going at the moment, whether someone who just uses a scooter for the purposes because they don't want to walk to the Loblaws at the end of the street is disabled. But anyway, the point is that anything that increases access for people with disabilities can be passed on. It promotes energy or water conservation is another good one, and this is true whether or not, by the way, the tenants pay for the water, pay for the energy. For example, like, you know, I often get ones where we've done like thermal pane windows, and the tenants are like, well, either we pay for the energy anyway, so what difference does it make to you? And it makes no difference at all. The idea was that the legislature or the framers of the regulation are trying to promote these type of things in the public interest. And so if it does promote energy or water conservation, then you can pass the expense through. And finally, if it improves or it maintains or improves the security of the residential complex or part of it. The common thing here, which I'm seeing more and more of, and by the way, I can't tell you the benefits that these things entail or provide when you go to try cases against bad tenants and whatever, and you can actually, you know, I didn't start a fight. Oh, well, here's a video from the hallway of you, and yeah, it looks like you're in a fight. So security cameras are a good one. Front door entry cameras and systems are a good one, all depending on, you know, the individual circumstance and what you want to spend on it. But all of those type of systems are things that are inherently eligible to be passed on by way of a capital expenditure. There are some exceptions. You know, first of all, the capital expenditure, apart from the stated exceptions here, they can't be things that are just cosmetic, right? Like you can't putting in a higher end lobby to increase higher rent paying tenants is not a capital expenditure to the extent that the lobby didn't need replacing because the other things worn out. And again, here you get into a bunch of nuance as well, right? Like if it's purely cosmetic, then it's not a capital expenditure. But let's say you have a lobby that's basically fallen apart and the things in it need to be replaced one way. At the same token, you can't say that simply because I put in a nicer lobby, which has the benefit, or elevators. There's a classic one. If your elevators need to be replaced, you can't claim that they aren't eligible just because you put in a lot nicer elevators than the ones that you had. That's still a capital item that needed to be replaced for the purpose of maintaining those systems in the building. But again, there's some degree of nuance that goes into this, as there is in anything that involves legal argument. But the idea is that if it falls under one of the categories we just went through, generally speaking, it will allow it to be passed on. If it's something that's just like for the pure marketing of the building or whatever, like putting a new sign, a beautiful sign on the lawn, or building a statue outside to say, you know, so-and-so towers, best building in the world, whatever, that's not gonna be a capital expenditure. But to the extent that it's actual capital work done to the building, then generally it will be, regardless of whether it has a collateral effect of increasing the appeal or the marketing appeal of the building. So the other thing is that the system that you're replacing has to need major repair or replacement. If it doesn't, then it's not eligible, except getting back to the exceptions on the last item we talked about, which was the eligible, that if it promotes access for persons with disability, promotes energy or water conservation, or increases the security, then it's irregardless. Like, it doesn't matter whether it needed to be replaced or not. If it enhances those things, then it's nevertheless eligible. Yeah, and again, it has to promote or enhance those things. It can't just be like, although I don't really know why anybody would spend money on something that didn't need to be replaced or repaired unless it was serving one of these purposes. But nevertheless, those are the purposes it has to be satisfied if you want to claim it, and it doesn't inherently require major repair or replacement. An example, oh, here's a good example. If you, for the energy or water conservation, what if you took the life expectancy from windows, excuse me, I can't remember it offhand, but it's either 15 or 20 years. And what if you take out windows that were 10 years old and put in like thermal windows or whatever, even though the thing hasn't reached its end of its life expectancy, you can nevertheless claim them because they promote energy or water conservation.
Excellent. Allistair, we had a question from Maria. Maria, can you unmute, please? All right. Okay, I'll ask on behalf of Maria then. Maria asked if the increase is always 1%.
Oh, no, absolutely not. I will get to that momentarily. I was just using an example, I was just trying to demonstrate the difference between the revenue models in large multiple unit buildings and revenue models when you're dealing with small units, in the sense that it can be an incredible revenue model to be increasing the rents by 1% in a 500 unit complex, whereas for your condominium it's probably neither here nor there.
Right.
That was the only point I was trying to make.
Great. And you know what, Chris, our other speaker, had found the useful life table that Allistair was talking about. It's in the chat, so folks bookmark that. All right, Allistair, let's continue.
So the other thing is that when you're doing these capital expenditures, it's not going to be, they're not applied to all the units in the building equally. I'll get to how they're applied in a minute, but one of the exceptions to them is that they're not going to be applied at all to tenants who rent the units after the work is done, because the market rent that they pay will inherently be deemed to take that into account. Like, let's say you put in brand new elevators in the building and you're claiming it as a rent increase for all the tenants who were already there. Well, a guy who rented the unit after you put in the new elevators, that's already going to be accommodated in his market rent, right? Like, it's not affecting the existing rent that he was paying before you did the work. Rather, he's coming in there saying, hey, these are really nice elevators, and that's forming part of the decision and calculation, market calculation of the rent that he's paying. So anybody who moves in after you do the work, and this goes for each unit, like if you claim balcony repairs, elevators, and a roof, and a tenant moves in after the roof, or sorry, before the roof, but after the balcony repairs and the whatever else, parking lot repairs or whatever I said, then only the expenditures that were done before he moved in will be excluded, and anything that was done after he moved in, you can still claim. Does that make any sense?
Yes.
So, yeah, all right, thank you. So like basically whatever work whatever work was done before somebody moved in, you're not going to be able to claim from them, but you'll be able to claim from everybody else. And basically you're just going to end up that portion of it that was applicable to the one tenant who moved in, and a new tenant is going to basically be lost. But it won't be lost because, as I say, the guy will be paying a much higher rent because the building already had those benefits. So it's lost in the application, but from an actual revenue model, it wouldn't be lost. It would just be put into the wash of increased market rents and this type of thing. Okay, so here's the limits on, which is I think what the question was asking about. If the board is satisfied that an order permitting the rent charge to be increased by more than the guideline is justified, and that the percentage increase justified in whole or in part by operating costs related to securities and by eligible capital expenditures is more than 3%, then the percentage specified under clause 10A that is attributable to those costs and expenditures shall not be more than 3%. And then it goes on to say that you can carry two additional 3% forward for in each of the 2 ensuing years. So that the amount above the guideline is 2.5% this year. So you can never, in any application that you file that's effective this year, get more than 5.5% in this year. However, if you say, for example, you justify, let's say you justify the maximum, which is 9%, 3% over 3 years, total justifiable 9%. Then you would take 5.5% this year, the guideline 2.5 plus the 3, then 5.5%, assuming the guideline is 2.5% next year, which it likely will be because we're in an inflationary climate, another 5.5% that year, and then finally 5.5% the following year after that. And that again is where I'm come up with the conclusion that for smaller buildings and whatever, this often isn't worth it, because I mean 3% of $1,000 is what, $30 a month. So I mean, even if you qualify for the full 3%, you're going to get $30 a month over 12 months in the first year, which is going to give you $360. Like, you know, and there are, there are a lot of administrative issues that go along with it, which I'll get to shortly as well. But that's why I say that it doesn't necessarily make a lot of sense. First of all, even if you do the work yourself and just make out the forms, which is, for that type of an application, it's fairly easy to do. The board is going to charge you $233 just to file the thing. So, in the first year, you're up $100. Plus, it'll take you 4 years to get the thing to even get an order on it anyway. So it could be a whole lot of trouble and cost for nothing. If it's worth it, because, like, if you're renting out a house or a duplex or whatever, it's really not, the value of that asset isn't necessarily dependent on cash flow the same way as it is with, again, 100 or a 200 unit building, which basically is being sold on cap rate, right? Like the value of your house that you rent is valued more in line with residential real estate values, and not simply as a function of its income stream that it's producing. So, for that reason, there's just less benefit to doing it on smaller buildings, but it can certainly, there's still, you're perfectly entitled to do it, but
Alistair,
the benefits
if you rewind, Alistair, can you rewind a little bit and tell us a little bit about the cost to apply for an AGI? You say it's not worth it, but what does the costs look like?
Well, I mean, the board charges $233. I think it is, last I recall. $233 if you're talking about it for the first 10 units. So I'm talking about for small buildings, right? Where you're gonna have less than 10 units. The board's gonna charge you $233 to apply.
Okay. What about the paralegal costs, for example, if someone were to hire?
Well, that depends on who you hire or whatnot, but for, again, for small buildings, it's not a great deal of work. I mean, I'm maybe the wrong person. I mean, the range of people's rates ranges anywhere, from, I don't know, of whatever. You can go like $100 an hour on up, and it depends on who you hire and what type of experience. But it's not like, if you're doing a single unit or whatever, or a triplex or a duplex or whatnot, then it's not going to be. I wouldn't expect it to be a whole lot of paperwork, and I wouldn't expect it to be. But the process that I'll get into too, how these things are decided, is a little bit like, it's not just you file the paperwork, you go for a hearing. It doesn't quite work like that. Although it may work like that in simpler ones that are smaller buildings, that may be effectively what you end up with anyway, because they don't ask a lot of questions and this type of thing. Like, if you're claiming that I put a new roof on a 3-unit building, I don't expect there's going to be a lot of questions or back and forth that you're going to have with the tribunal about that. It's like, here's the receipt for the roof. Here's the check that's canceled to say I paid for the roof. It's a roof. There's one item involved. And, like, I don't expect it to be that complicated. If you're getting into the 300 unit complex where there's like, 5 or 10 various items, all of which can be questioned and challenged, then you'll often get into a banter. You'll file the application, and after you file the application and they sit on it for, months, years, and get around to looking at it, then they'll send you a request for particulars and ask you, or letters like saying that we're going to dismiss, like the one that I told you about with the thing about the 18 months during COVID. They'll send you the Aggie unit. These are all dealt with by a separate area of the tribunal called the Aggie unit. They don't go to the normal, local office. It's all done out of Ottawa. And the Aggie unit will send you back a letter saying, yeah, you need to explain this, and this, or we're going to dismiss it because it's out of time, because we found that all the items claimed are beyond the 18 months, or so on and so forth. And there's a bit of sort of back and forth that goes on where there's anything remotely contentious. And your ability to sort of command the conversation and make effective legal written argument is essential, because at that stage, because if you don't satisfy them, then it's just like, good night, Irene. They'll just throw the thing out.
Yeah, Yeah, awesome. Allistair, we have several questions in here. Observer, can you unmute and ask your question, please?
Hello.
Yes, go for it.
Yeah, so I was, my question was, are you going to be talking about the AGI for municipal tax increases? So it's so relevant nowadays with the Toronto, Municipality of Toronto increasing the rate for so high.
Yep, I absolutely will. I think it's the next slide, if not, unless let me just see. I've gone through that. Oh, I was just going to speak briefly about calculating the increase. This is the actual, for capital expenditures. This is the actual way that the statute requires it to be done. The two of them I found has been sort of like saying, well, you know, take 3, divide it by 6, and then multiply it by 2, as opposed to saying, take 3, multiply it by 2, then divide it by 6. It comes out to the same thing, and I don't know why they changed it. It's more obtuse when you do it this way. But anyway, this way involves multiplying the amount of the expenditure by the rent for the unit, dividing that by the rent for all the affected units, the units affected by that particular increase. And I've used an example of $100,000 elevator repair multiplied by $1,000 rent, as if there was any such thing, to come up with $100 million. Is that something like that? A large number of, and then divided by the rent, and you come up with a $2,000 figure after you've done all of that. And then in the next stage, you amortize the amount, the $2,000, over the useful life of the elevator, 20 years of blended principal and interest payments. The rent you use always is a 5-year mortgage rate as published by the Bank of Canada. And that's a very important thing, because what the idea is with these capital expenditures is the rent increase that you get every year, which is the inflationary increase, isn't really intended to cover the necessary repair. Doesn't cover the necessary repairs and capital work that has to go on to the building. So the idea with these, you know, that's why it's based on the 5-year mortgage rate, is like, so that if the landlord went out to the bank and theoretically borrowed the money to do the needed capital repairs of the building, the increase that he'd get to the rents would cover the cost of borrowing that money at the published 5-year, Bank of Canada published 5-year mortgage rate. And that's really the whole mentality behind that. Although, as we'll get to shortly, it actually works out a lot better than that for a number of reasons. So in this case, you would amortize the $2,000. This was an old presentation. The rates have gone up a lot since then. At 5.3% is $13.58, and then you would divide the allowance by the rent and multiply by 100, which would allow you to increase the rent by 1.358%. And that's the way that technically you're supposed to do it. I never do it that way. I find it to be horrible. And also you have to separate all the, it just takes a really long time, and not the way that I like to do it. The simplified method, which is simply the way that they used to be able to do it, is available to calculate the increase. I say the approximate increase because not all items will be applied to all units, but this will certainly get you to where you need to be to decide whether or not you want to even bother doing this type of thing. And the first thing you do is you calculate the maximum monthly allowance for each of the expenditures by amortizing them over the useful life of the item in the blended equal payments of principal and interest, again using the 5-year Bank of Canada rate. And then you add all the allowances for these various items together and divide by the monthly rent roll for the building. So are you still sharing the screen with a spreadsheet on it?
Yes, you're on the spreadsheet now. Sample AGI,
right,
CapEx allowance.
Off the spreadsheet's another question, but I'll figure that out later. So this is an idea of an example of, you know, a sample one. For this one, we spent landlords spent these various items on parking, concrete driveway repairs, garage door, fire rated doors, etc. And so you amortize each of these items over their useful life. I use the more, it's not the rate, it was higher than that. I don't know where it is exactly at the moment. But recently it's been around the 7%. And then you come up with a blended interest and principal payment for all of those things. And then if you add all of those together, then theoretically the maximum amount of money that you're going to be able to recover out of all the tenants in the building is going to be this amount monthly, is going to be this amount down here, which is $1,016.51. And then if you divide that by the monthly rent roll for the building, you'll come up with an approximate rent increase of about 2.9%. You see the way that I'm doing that, or? Like I'm figuring out what you're gonna be able to calculate to capture back from each one of these things monthly by amortizing them. Then I'm adding them all together, so that's gonna get you the $1,016.51 is gonna be what all of this should give you, presuming you have no new tenants who moved in and whatever, where you're gonna get the rent anyway, because they're gonna pay more. But this is what the maximum amount you could get from amortizing all these expenses over their useful life. And then you divide that by the monthly rent roll for the building, and that's what gets you the 2.9%. And again, while you do it, which is sort of the later on in the presentation, but seeing I'm on the spreadsheet now and also seeing as I have to figure out how to get off it. The other thing is why you would do this, because as Chris will inevitably tell you, that the cash flow is most valuable in terms of its capitalized value. So if you're getting $1,016.51 a month in extra cash flow, your expenses haven't increased any, like your maintenance and all of that, right? These are capitalized expenditures. So you're getting $1,016 a month. That translates to $12,198.15 a year in added cash flow. And assuming that properties of this class trade at a cap rate of 3.5%, when you divide the $12,198.15 by 3.5%, you've basically put $350,000 onto the value of your building. So in this way, you've taken, just by working the cash flows, because if you recall, you've taken $112,000, which is the total cost of these repairs, and you've amortized it in blended principal and interest over 15, 10, 20 years. In any case, a lot shorter than the amortization of a mortgage. And if you're selling at a straight cap rate, which isn't blended principal and interest, it's just straight capitalization of an income flow, you've actually almost tripled the amount of equity that you put into the building over the amount that you actually spent on the repairs.
Allistair, quick question on this. So we had a question in the chat about this maximum monthly allowance. How was that calculated? Did you add all of the allowance components right here?
Yeah, exactly.
Yeah. So add together equals the bottom right here. All right. Salernus, was that your question? Can you unmute? Okay. I'm going to assume that was it. If not, feel free to ask another question. And then we had a question from Carrie. Carrie, can you unmute, please?
Hi.
Hi.
Yeah.
Hello.
Hi.
Yes, go for it.
So I'm a property manager, and I left my previous job before the court went through. They had done some capital projects, increased the rent, another, I think 5% to do some capital expenditures. And a lot of the tenants got really upset, refused to pay. And then they were taking the landlords to the tribunal to dispute the job that they did.
Yeah.
And And then they turned around and they didn't get the exact 5%, whatever it was. They only were allowed, I think, 2% out of that. And then there was just a whole lot more paperwork to have to go through and, you know, to refund and do everybody's rent again.
Yeah, well, I mean, first of all, and I do have another slide on that. That's just a part of doing this process. Like I would never, and again, it's from experience, right? Like I've had situations where we've said, for example, like in the first line I'm talking about here, parking lot paving and repair over 15 years, and we went to a pre-hearing conference, and the board had given us like a way shorter life expectancy. And because we'd already sent the notices out for using a 15-year life expectancy, all we could get was a life expectancy that came from the 15-year cash flow analysis. So I always tell people, like, you're never going to be exact on these calculations of what you're going to get. So I always tell people to overshoot. And then because you're going to be adjusting one way or another. And if you have to adjust all the rents in the building, whether you adjust them by, 35 cents a month or $3.10 a month, it really doesn't make any difference, right? You're going to have to go through once you get your order and it says that, well, you thought you were going to get 3.48 and you got 3.42. You're still going to have to go and adjust all those rents. Actually,
Yeah.
it can't be more than 3, but you know what I get.
Yeah.
You know what I mean?
Perfect. Well, thank
And
you.
also, like, that thing I was talking about at the beginning, at the Keenest Investments case, that was exactly like a lot of the times, like I've seen, I haven't been involved in any of them, and like that have gone on recently, but that's been an old thing. Whereas you're going to apply to increase the rents, we're just going to not pay the rent and have a rent strike and all of this type of stuff. I dealt with tons and tons of those, but there's not, again, you can't really do anything about it. You used to be able to in the courts because you just basically fold it into the class action and have it ordered that anybody who didn't pay the rent into court would be automatically evicted on a motion, but they don't do that type of stuff anymore.
No.
And but yeah, that's and what are you going to do? I mean, the ultimate thing, you can try talking to the people and say, look, you can first explain that these repairs that you're applying for are not included in your annual rent increase. Like, these are over and above. The annual rent increase is 2.5%. And if you've been to the grocery store lately, you could probably figure out that inflation is a lot higher than 2.5%. And even though that's the case, you're only allowed to charge 2.5%. And on top of that, we've got to put a new roof on the building. We have to do the balconies or they were going to fall off and, down piece of concrete hitting you in the head type of thing. It's not, these are work we have to do, and it's not accommodated in the annual rent increases. And you can try talking to people. Like, I've done that too. I've gone to apartment buildings where they have the tenants association and where they have, I was at one just before COVID where they had, what's that group that, it sounds like the one they had in the States with the political action group.
Acorn.
Acorn?
Yeah, that's those guys. They were like marching outside one of the clients' buildings, and I went up, and I actually thought I did really, really well. I convinced them, like, because it was actually, they were rallying. It was stupid because they were actually rallying outside a building that we had just gotten a whole bunch of a deal with the CMHC and the government where we weren't even eligible to increase the rents, because we had gotten all this low cost money from CMHC and whatever. And these guys are rallying outside that building against the unfair rent increases that are going on. This building can't even increase the rents. Like, what are you talking about? Anyway.
Yeah.
A lot of
Good
stories.
stuff. Yeah, Allistair, let's answer one more question and then let's continue, because I'd love to hear from Chris on the fact that how he did 3 rent increases with you, right, or above the guideline increases. Okay, Greg, could you unmute and ask your question, please?
Oh yeah, the
Sorry,
question
I just
was.
re-extended my thing.
Yeah, the
Yeah,
question
Greg's-
was if the increase isn't approved yet, by the time the next 12 months is like increase comes out, how would you calculate it if it's not approved yet?
Well, that's been a huge problem, frankly. You mean in terms of you give a notice of rent increase for, say, the 5.5%, and then the next increase comes due before the application is decided, which is almost always the case. It takes like 3 years plus to get these things decided these days.
Yeah,
The
that's right.
question?
Yes.
Well, I mean, I have been tending towards the thing that whatever you do, you're generally safe if you are as clear, as long as it doesn't tend to confuse the tenant, then your notice is going to be the notice of rent increase or notice of termination or what have you is going to be deemed to be compliant. So the best thing you could possibly do is to write the tenant a letter saying, last year we gave you an increase of 5.5%. This increase here is for the guideline of 2.5%, but it's based upon last year's increase, which still hasn't been approved. And as long as you do whatever you can to, and it's relatively clear and whatever, to explain to the tenant, because you could check off the box, like the other thing I was telling people to do is to give it for the 2.5, but check off the box saying it still needs approval. But that doesn't make a lot of sense either, because that box is in a section of the notice that says the increase is more than the guideline. And this increase isn't more than the guideline. It's the one you gave last year that's more than the guideline. So I would say that the simplest and the most explanatory thing you could do would be to write the tenant a letter, just a form letter that goes along with each of the notices of rent increase. Dear tenant, you'll note last year we applied to the tribunal for a rent increase above the guideline and gave you a notice of rent increase for 5.5%. Please find and close this notice here, which is for the guideline. We're not, you can even flower it up. We're not increasing the rent above the guideline this year at all, but this notice is based on the guideline, which still needs approval from last year. And the amount of the increase is based on the full amount of the increase, including the above guideline increase from last year. And once the tribunal makes a decision, then we'll go back and retroactively readjust all these rents.
Wow, that could get very complicated.
It is, it's horrible.
Yeah. Okay. All right. Tell us more about Simplified.
All right.
Increases.
Oh yeah, this is the municipal taxes and charges. This is going to be short and sweet because it's very simple. So you can also base the municipal tax, the application for the above guideline increase on an extraordinary increase in the cost for municipal taxes and charges for the residential complex or any building in which the rental units are located. Then what is an extraordinary increase? Basically, the extraordinary increase is an extraordinary if it's more than the guideline plus 50% of the guideline. So like this year, where the guideline is 2.5%, the guideline plus 50% of the guideline is 3.75%. So if the municipal taxes go up more than 3.5%, sorry, 3.75%, you can pass on the amount over and above the 3.75% entirely to the tenants. You don't get the first 3.75% or 150% of the guideline. That you don't get. But what you do get is any amount over and above the 3.5%. So 75% in this year example. Sorry, I'm just trying to rush through this here to get a little because I know I'm over time. When the other thing that you can only claim it in the year following the rent increase. It's not like I get people calling me up saying, "Hey, my taxes went up 7% like 4 years ago." Yeah, unfortunately not. You can only claim it during the year after the increase is imposed, and that's because the way it's worded, it's based on a reference year and a base year, and the base year is the year that immediately preceding the day that's 90 days before the effective date of the first intended rent increase, and then the reference year would be the year before the base year, or, you know, like, cause you calculated from one year to the next, obviously, to determine what your increase in taxes were. So the key takeaways from this are it has to be claimed in the year following the increase. It's extraordinary if more than the guideline plus 50%. Only the extraordinary amount can be claimed. Here the example: if your tax goes up 5.575% and the guideline is 2.5%, then you can claim the amount above 150%, i.e. 5.75 minus 3.75. You can pass on 2%, not 2% of your revenue, 2% of the tax increase, obviously. And but unlike the 3% max, and I have had some of these, by the way, I've had buildings where the tax increase has been absolutely astronomical, and we've applied for like massive rent increases on the building. I have no idea why. Doesn't matter why. The taxes went up, we pass them on, but there's no 3% cap, and it's added to whatever you claim as a capital expenditure. So like if you can apply in the same year saying, you know, and sometimes that's beneficial, right? Like it's like, do I really want to apply? My taxes went up, you know, 3.9 or 4.1%, and I can pass on a tiny amount, but I've got these capital expenditures also. You can add them all on the same application and you know, put them all through at the same time. And so it works like that too. The other thing with these are like, and I found this actually has been the case. The hearings for these things, like they give tenants, if they're done by written hearing, like they'll send out a notice that you then have to go and serve on all the tenants saying, make your submissions within this period of time, Mr. Tenant, and whatever. But I mean, this is just like an accounting. They look at the tax statement from one year, look at the tax statement from the next year, figure out what the percentage increase is, take away the 3.75%, and that's the increase. Like, it doesn't matter what the tenants have to say about it. It is what it is. So they process these things faster than they do the capital expenditure ones, which take years and years and years. And that's what I'd say about that. Basically, the procedure is you file the application 90 days before the first effective date of rent increase. Whenever you have a first effective date, the rent increase will, or above guideline rent increase, will run for a full year after that date. So let's say that you apply with a first effective date of June 2024, then the above guideline increase period will run from June of 2024 till May of 2025. And why that is because people have different anniversary dates during the course of the year, right? So you can't, not everybody's rent's going to go up in June. Some people, their rent goes up in January. Some people it goes up in March. Some people it goes up in November. So during that 12-month period following the first effective date, any of those are going to be effective as they come around to their anniversary dates and as they roll around that way. Then, as I say, once you file your application, the AGI unit will assign a file number and bill you, and they'll screen the application sooner, or, you know, like it doesn't usually take that long, but it can take months. But they will send you a letter to notify you of any issues that need clarification. Oh, we saw that you're missing a check for this, or we wanted to know why this work says it was completed on June when the last invoice was paid in May, and this type of thing. And they'll ask you to clarify all of those issues before they'll send it to a hearing, which is a good thing, because it's not like they sort of screen it, and if there are any technical issues or whatever with it, they'll let you know, and they'll give you an opportunity to correct them. They won't just send it to a hearing like they do with the notice of termination, and then 8 months down the road when you get to that, you really shouldn't have sent this by email. Bang, gone. With these things, at least they let you know in advance if you did something and give you an opportunity and to deal with it in that way. And the hearings can either take place in writing or by Zoom. Recently, I found a lot of the the capital expenditure hearings even are going by Zoom or going by written hearings, where they'll just literally send you a package, like a sheaf of documents. It's probably costs more to photocopy the applications and give them to the tenants than the $233 you paid to the tribunal, because they've got everything, French language services, interpreter services, how to participate, the whole 9 yards. And you have to go and give them to all the tenants, and it just says you have to make written submissions. And you may think, hey, this is great, now I can do this all in writing, but that's fine. I had one where one of the tenants was a retired lawyer from so and so and so forth, and it just, like pages and pages and pages of this nonsense to have to respond to. And then I responded to it, and then I got another 50 pages. And then I just said, I'm not paying any more attention to that. And then I got a written argument on why the fact I told him it was unsolicited and I wasn't going to respond to it entitled them to further relief yet still. So, but anyway, they're generally more efficient if you do it in writing, because like I say, it's at the end of the day, it's an accounting principle. It's not, these are accounting functions. They're not like, for the person who asked the question, the fact that your landlord may be a slumlord, or the landlord has been harassing you, or the landlord hasn't done this other work in the building, has absolutely nothing to do with whether he actually replaced that elevator and how much it cost him to do so. And so, like, at a hearing, when you actually go to a hearing, then none of that will be allowed. The way that they usually do it these days is they have a case management hearing, which is with a DRO, and the case management hearing, the DRO will say, like, they're very, very good at facilitating things and whatever, but they'll usually take them into a private room, send the landlord into another room and say, look, all of that, great, you can file an application, whatever, it's not going to make any difference to whether or not they get the rent increase for this application, unless you can challenge the amount they spent, or whether or not it was an eligible expenditure. Then none of this is going to make any difference at all. And at the case management hearings, by the way, it's always good that you got to give something to get anything, right? So they will calculate out beforehand on this information package, they'll say the landlord justified an increase of 2.4%. So then you'll go to the case management hearing and you'll decide, okay, because the officer will say to these guys, look, if it goes to a hearing, unless there's something wrong, they're going to get the 2.4%. And I said, so you come with it like, well, look, I'll say, we'll give you 2.2%. So if you agree to 2.2% now, then we can get this over with and not worry about it. Or you can wait and we can wait and you'll pay the 2.4%. And so that's basically the way that you handle those things. This is just what I already would do. So this is redundant. The applications are decided on the basis of, are the items claimed eligible, and are the amounts claimed properly expensed and amortized in accordance with the regulation. Generally, the other issues aren't allowable, like poor maintenance, it's not fair, I shouldn't have to pay more rent, the landlord is whatever, none of that really matters. The hearing procedure will depend on the type of hearing. Then I've just already talked about that, the case management with the DRO. I also already talked about this also, but they will have already, in the information that they send you, they will have already done all the calculations, which you perfectly, don't get me wrong, it's not like they've already calculated it and you can't dispute it if they calculated it wrong, which they did. I mean, recently I had a thing after 2.5 years where we had the thing with the DRO. They sent out the notice saying we've calculated X, we agreed to 0.2% less than X, and then we got an order from the adjudicator, one of the vice chairs, saying we calculated it wrong, forget your consent that everybody agreed to, we're going to send it to a hearing 2 years down the road anyway. Like, anyhow. Oh, that's the last one. So the main benefits, I've already been through this in the spreadsheet I showed, but the 5-year published rate's higher than the cap rate that buildings currently trade at. I don't know what buildings are trading at currently, but they're, you know, in the 3.5 to 4s in major urban centers, and I think a little bit higher outside. The 5-year published mortgage rate is like 7. So obviously there's and plus you're amortizing the amounts over a shorter period of time than a mortgage, which I've already spoken about. And then I've already gone through this in the spreadsheet, the increased cash flow and increased equity and sale value, which I already went through in the spreadsheet. But again, like, you know, like this is appreciating that the numbers on buildings that, like large buildings that trade on cash flow are different than the math of small rental properties, if you will. Like just the way that they function as an investment vehicle is inherently different. So, you know, you have to appreciate that as well. The drawbacks, you can't increase the units for units that have been rented since the expenditure was incurred, and those amounts are just lost. And so, I mean, it can be, you can say it's impractical for buildings with high turnover because you're just increasing a market and getting the same or not better results, even if you don't do the application. If you're talking about a smaller building, the cost of making the application, or like, you know, you can see from when I talked about the way these things go through the process, like there's a screening, then a written response to the screening, then a back and forth with the board, then a case management hearing, then a full hearing, and so forth. So they can rack up the legal fees, but you know, again, they don't rack up the whatever it was, $348,000 worth of legal fees on the example I used there. So it's still on a case of a larger building, well worth the money. Then there's the administrative problems, which somebody asked about already with the thing. It's going to go 2 or 3 or more years. And for each one of those years, you're going to have to send the rent increase notice, and then you're going to have to send a letter with a rent increase notice for the next year. Then you're going to have to answer like 100 phone calls on what does this all mean and whatever. You sent me a letter and I don't understand any of this, to which you can reply, neither do I, it's the government. But nevertheless, it's the same. It's, you know, it creates an administrative problem when you're running the building. The other thing to recognize is that the notices of rent increase give the tenants the option of paying the full increase, or only paying the guideline, which I guess they have to calculate themselves. But the other thing is you're not allowed to actually charge the rent. Like the tenant can pay it, no problem, but you're not allowed to charge it until the order actually comes out. So let's say you have a tenant and they get a notice for 5%, and they go along and they pay the rent for the 5% for a year, and then they lose their job or whatever the case may be. The application hasn't been decided. You have to go and adjust back the rent to the guideline because that's the allowable rent. If you put the rent plus that they've been actually paying, and then they're obviously going to be in a credit, right? Because they've been paying the 5%, and all you were allowed to really demand they charge is the 2.5%. So, and if you put the 5%, which they've agreed to be paying and are paying, on an N4 notice of termination, then the notice is invalid because actually the maximum rent that you're allowed to charge before the thing's decided is only the guideline.
Thank you so much for tuning in today. I hope you've learned at least one new concept. Please consider subscribing or giving us a thumbs up so we keep sharing high-quality educational courses on Openroom University. Check out our other videos to make sure you stay informed. If you've got feedback or just general ideas for my team at Openroom.ca, please send it to us at hello@openroom.ca. Cheers to a transparent and connected rental ecosystem.